In this video, I'm going over my top 7 stocks for the month of January 2022. I've researched hundreds of different companies, and this is my list of stocks I think are solid buys right now. I encourage you to watch all the way through to get my full analysis on each of these companies. I'll go over key numbers, recent news, and why I expect them to grow. Let's get started. The first stock on my list is Coca-Cola, stock ticker KO. Coca-Cola is an American soft beverage producer and multinational corporation best known for its Coca-Cola drinks. Right now, one share of Coca-Cola stock is trading at $58.22. With a 52-week low of $48.11 and a 52-week high of $58.92. If we take a look at their 1-year price chart, we can see that they started the year at about $55 a share, dropped down in price to the high 40s, and since then we've seen a run back to its current price. Their market cap is $251.477 billion. They have a P ratio of 28.67, earnings per share of $2.03, and they have a mild dividend of 2.89%. Taking a look at their valuation measures, we can see that they have a 5-year PEG ratio of 2.5 and price to book ratio of 10.96. Looking at their profitability, we can see that they have a profit margin of 23.31% and they have a very great return on equity of 39.72%. This is all on revenues in the last 12 months of $37.8 billion. Now their balance sheet shows total cash of $14.87 billion and they have a great current ratio of 1.52. It's always interesting to see what analysts have to say, so on a scale of 1 to 5, 1 being a strong buy and 5 being a sell, analysts are rating Coca-Cola as a 2.2, meaning it is a buy. And the average analyst price target is $62.46, which is just under 10% higher than the current price of $58.22. We all know Coca-Cola. Coca-Cola has been a public business ever since the early 80s. And for the past 4 decades, it's proven its ability to not only survive, but also continue to grow in a changing market. To date, there are no soft drink companies that can really rival Coca-Cola except for maybe Pepsi. And Coca-Cola maintains its reign in the soft beverage industry by matching the prices of its competitors, constantly ensuring the affordability of its own products, reinforcing its global presence and its brand by just continually producing delicious products that people will likely never grow tired of. To add on to that, Coca-Cola is such a potent company and business, not just because of its endlessly successful Coca-Cola drink, but also because the company owns huge beverage brands such as Dasani, Sprite, and Powerade. In its most recent earnings released back in October, Coca-Cola reported that its net revenues grew 16% year over year to $10 billion, with a growth in net income of over 40% to $2.5 billion. And as a result, analysts have raised their expectations for the company's next earnings update, which will take place on February 9th. The run-up to that date could be bullish, especially given the positive analyst expectations for the company. Another great thing about owning Coca-Cola stock is its dividends you receive as a company shareholder. I generally think that it's a good sign when the company is able to pay out dividends because it shows that the company has such a remarkably large pool of liquidity that it is willing and able to give cash back to its shareholders. Overall, Coca-Cola as a company has proven itself to be one of the most durable and successful in the world, and that combined with its recent performance lands it a spot in this video. The next stock on our list is NextEra Energy, stock ticker NEE. NextEra Energy is an American energy company headquartered in Florida. By market cap, NextEra is the largest electric utility holding company in the world. Right now, one share of NEE is trading at $90.70 with a 52-week low of $68.33 and a 52-week high of $92.70. Looking at their 1-year price chart, you can see that we did see some ups and downs in the last year. But since about 6 months ago, the price has really gone up with a small correction back in September. The current market cap is $177.966 billion. They have a very high PE ratio of 147.72, meaning that it is definitely overvalued compared to earnings. They have an earnings per share of 61 cents, and they have a mild dividend of 1.7%. Their 5-year expected PEG ratio is 3.73, and they have a price to book ratio of 4.83. Their profit margin is sitting at 14.4%, and they have a very low return on equity of 3.87%. On their balance sheet, they are holding about $692 million in total cash, and they have a low current ratio of 0.47, something that I definitely think they can work on. Analysts do love this company, and they are rating them a 2, meaning it is a buy, and the average analyst price target is $93.80, which is about 3% higher than the current price of $90.70. NextEra Energy specifically provides clean energy for a good chunk of North America, with its involvement in and development of wind and solar power technology and its operation of energy generating plants that run on oil, natural gas, and nuclear energy. In this new era where clean energy and green technology seem to be trending markets, NextEra Energy is definitely a refreshing sight for energy companies. In my opinion, they are cementing their place in the future of renewable energy by investing in research for green hydrogen, which is an alternate product of renewable energy that generates much less carbon than gray hydrogen, which is what 95% of the energy market emits. In other words, NextEra Energy is already looking at the future of renewable energy and zero emission power, which I think is an important step in this new market-wide search for greener energy and more sustainable resources. The company has also gotten to work on building clean energy stations throughout the country, including solar energy centers in Florida, Maine, and Vermont, as well as its wind farms in Indiana, Wyoming, Oklahoma, and Arizona. This tells me that the company has the resources, the personnel, and the vision to execute clean energy projects, which definitely makes it easier for me and other investors to put faith in their future objectives. Back in October, they announced their earnings, specifically reporting a year-over-year growth in net income and earnings per share for Florida Power and Light, or FPL, its main subsidiary. This is an important statistic because as of right now, FPL is NextEra Energy's primary source of revenue and profit that allows it to fund its sustainable energy projects. The energy company's next earnings release will take place on January 25th, so definitely be on the lookout for that. Given its mission and the results it's generated so far, NextEra Energy will definitely be on my list of stocks to watch. It's almost the start of a new year, and that means it's the perfect time to buckle down on investing. That's why I'm super excited to tell you about Wealthfront. Wealthfront is an investing platform that uses software to automate your investing with index funds and more. That way, investing can be hands-off, more diversified, and historically less prone to volatility while still maximizing returns. Wealthfront offers many account types, including a Roth IRA. This is what I personally use, and it's a fantastic tool to pay fewer taxes on earnings during retirement. Even if you have a 401k through an employer, you can still open up a Roth IRA on Wealthfront and take advantage of tax-free retirement earnings if you're eligible. And you have until April 15th, 2022 to contribute for 2021. So now's the perfect time. Their setup process is super simple. You just have to answer a few questions and let them know that you want to open up a Roth IRA and how much you want to invest, and they'll handle the rest. You don't have to worry about investments to choose because they will create a personalized investment portfolio based on your risk tolerance. And you can even customize the sectors you invest in to your liking. Sort of view it as your personalized financial advisor, except it costs way less. And they can even help you look for opportunities to lower your tax bill through tax loss harvesting. Right now, you can get your first $5,000 matched for free with my link in the description, and after that, it's just a super low 0.25% annual management fee. Use the link below to check them out and start automating your investing before the new year. And now back to the video. All right, next up on our list is Berkshire Hathaway, stock ticker BRKB. Berkshire Hathaway is a multinational conglomerate founded and led by Warren Buffett. The holding company completely owns major companies and brands such as Geico, Duracell, Dairy Queen, and Fruit of the Loom, and owns shares in companies including Kraft Heinz, American Express, CocaCola, Bank of America, and Apple. Right now, one share of BRKB is trading at $294.36 with a 52-week low of $224.21 and a 52-week high of $301.58. Looking at their one-year price chart, we can see that they had pretty steady and generous growth within the last year. They have a 5-year expected PEG ratio of 9.12 and a price-to-book ratio of 1.36, which is definitely a good sign because it means that the current value of the stock is just a little bit over the book value. They have a profit margin of 32%, they have a return on equity of 19.34%, and Berkshire Hathaway right now is sitting on about $149.2 billion in cash, which places it in a great position if there is a market downturn. Their current ratio is 1.61, which is also very good. Right now, investors are rating Berkshire Hathaway as a 2.4, meaning it is between a buy and a hold, and their average analyst price target is $337, which is under 15% higher than the current price of $294.36. To answer the question that some of you guys might be asking, Berkshire Hathaway does have two classes of stocks, Class A and Class B. However, they are still virtually the same because they represent the exact same company, Berkshire Hathaway. Back in the 90s, Berkshire Hathaway issued their Class B shares so that more investors could afford to invest in the company, because one share of Class A stock at the time was worth around $30,000 to $40,000. And as we know, that number is still going up to this date. Now, with Berkshire Hathaway and specifically with Warren Buffett, the name of the game has always been long-term profits, which is why he never actually split the Class A stock in the first place and issued the Class B stock. He wanted his investors to rely much less on short-term price fluctuations and more on the durability and competitive advantages of the businesses that he chose. As a result, they are one of the most reliable long-term investments out there because its catalog of assets taps into many different markets, making it foolproof if a specific sector in the market is down. They're also very strict about selecting and holding companies that exhibit strong long-term competitive advantages, a prime example being CocaCola. Therefore, if you want a relatively much safer and more reliable and steadier place for investment to grow, there are few investments better than Berkshire Hathaway. And yeah, I chose to talk about BRKB because it's far more affordable than BRKA. And just for fun, if you guys had invested $20,000 into BRKB back in 1996, your investment would be worth around $245,000 today. So yeah, overall, I think BRKB seems like a good stock to invest money into at any point or time because they are not just one business. With the markets the way they have been, that's why I tend to stray more towards index funds and stocks like BRKB. So definitely check this one out if you are more into the long-term investing game. All right, next up we have Zillow, stock ticker Z or ZG. Zillow is an online real estate marketplace business that allows users to list properties for sale or for rent. And you can also look at real estate listings, view estimated property values, and seek other relevant and important real estate info for free. Right now, one share of Zillow is trading at $62.34 with a 52-week low of $52.31 and a 52-week high of $212.40. Yes, that means that the value of Zillow right now is about 75% off its all-time highs. And if we take a look at the one-year price chart, we can see exactly why that is. Back in February of this year, they actually hit their high of over $200, and ever since then, the share price has just dramatically dropped. They have a current market cap of $16.142 billion and an earnings per share of negative 90 cents. Their valuation measures show a price to book ratio of 2.61, and their profit margin right now is negative 4.36%, and their return on equity is negative 4.38%. In the last 12 months, they've done about $5.05 billion in revenue. They're sitting on total cash of about $3.22 billion, and they have a very great current ratio of 2.52. Analysts are a little bit more cautious on Zillow, rating it at 2.6, meaning it is between a buy and a hold, but the average analyst price target is $88.18, which is about 30% higher than the current price of $62.34. Zillow's business model is powerful because it's free for clients to use. Much of the revenue that Zillow brings in comes from the advertising that takes place on its website. However, an issue that the company has faced as of recent is its cancellation of its iBuying, meaning instant buying operation called Zillow Offers. Zillow Offers has been its hottest selling point for the past few years, and instant buying appeals to real estate consumers by eliminating the need for real estate agents and brokers as middlemen to settle real estate transactions, which makes the whole home selling process much simpler. While the bust of Zillow Offers definitely represents a roadblock for Zillow, what's happening is that Zillow is becoming incredibly undervalued. Just 6 months ago, they were trading at about $120, but right now its price has dwindled down to about half. Personally, I think that this value is quite low for it being the biggest and best overall online real estate company in the US. And with existing home sales rising near the end of the year, I think that it will be possible for us to see an increase in price. Yes, you could be catching a falling knife, but I think that the long-term outlook for Zillow is positive and should see a big recovery at some point. In their last earnings report, Zillow reported some net losses, which the company claimed was the result of its experimentation with the home buying business. While these net losses are definitely disappointing for investors, the negative response to the company by shareholders was certainly an overreaction. And these net losses certainly don't reflect the true core strength of Zillow as an online real estate marketplace. Their next earnings releases on February 9th, so hopefully Zillow has some more positive figures to report this time around. Either way, I still believe that Zillow is extremely undervalued, with its current price hovering around that when the pandemic first started. Personally, I will be dollar cost averaging this company into my portfolio. All right, our next stock is Extra Space Storage, stock ticker EXR. Extra Space Storage is an REIT or real estate investment trust that primarily invests in self-storage units. According to its website, when it comes to the operation of self-storage facilities, Extra Space Storage is the largest to do it in the US. Right now, one share of EXR is trading at $217.94 with a 52-week low of $106.56 and a 52-week high of $219.49. So yeah, if you take a look at the one-year price chart, we can see that this company has had the most consistent growth on this list, going from around $100 a share to more than doubling to where it is right now. Their market cap is $29.18 billion. They have a P/E ratio of 40.48, earnings per share of $5.38, and a mild dividend of 2.28%. Their 5-year expected PEG ratio is 3.38, and their price to book ratio is 9.34. They also have very great profitability with a profit margin of 46.45% and a great return on equity of 24.72%. This is all with revenues in the last 12 months of $1.54 billion. They're sitting on about $65.56 million in total cash, and they have a strong current ratio of 1.7. Right now, analysts are rating them as a 2.2, meaning it is a buy, and the average analyst price target is $220.79, which is just a smidge over the current price of $217.94. According to the Wall Street Journal, self-storage has been the hottest property asset as a result of the pandemic, which makes sense for many reasons. For example, during the pandemic, people were spending more time at home, like studying or doing work, so they would build their own at-home office or workspace, and now they need more room to store their other belongings. Companies that are afraid of a market shortage will stash even more inventory inventory in their facilities, which inevitably takes up a massive amount of room. And bored consumers at home will likely purchase even more products online, which also takes up a lot of space. Extra Space Storage's most recent earnings report definitely reflects this greater demand for self-storage units. The company reported revenues of $420 million and a net income of $188 million, which represents 20% and 64% year-over-year growth, respectively. Considering that Extra Space Storage was recently recognized as the self-storage sector leader for sustainability, as well as the fact that the company has enough assets to announce and distribute a quarterly dividend of $1.25 per share, tells me that this company is one of the best companies to invest in if you are looking to profit from the self-storage sector. They have yet to announce an exact date for its next earnings release, so in the meantime, definitely keep the stock under your radar. I think that this company is very promising for the foreseeable future, which is why I'll be investing money into them. All right, next up, we are talking about the Vanguard S&P 500 ETF, stock ticker VOO. This ETF is an exchange-traded fund that invests in stocks found in the S&P 500 index, which represents the 500 largest companies in the US. Right now, one share is trading at $432.63, with a 52-week low of $335.37 and a 52-week high of $435.41. We can see that the total net assets is $753.41 billion. They have an average P/E ratio of 9.03, an average dividend yield of 1.34%. The performance is also quite strong, with the year-to-date daily total return of 26.46%. So yeah, if you take a look at the one-year price chart, we can see that the S&P 500 has really grown in the last year, which is something that we can really expect long-term with an index fund like this. Now, like I said, because VOO has shares in the top 500 largest companies in the US, investors can expect a lot of well-known and blue-chip companies. And yeah, the diversification can really be great protection in the event of bear markets in specific sectors. So right now, the 10 largest holdings in VOO include Apple, Microsoft, Alphabet, Amazon, Tesla, Nvidia, Meta Platforms, Berkshire Hathaway, JP Morgan, and Home Depot. That is a ridiculously stacked portfolio, and personally, it makes me feel very confident about putting my money into this ETF. It is common knowledge at this point that investing into any S&P 500 ETF can lead to significant accumulations of wealth over time. So one thing that I really like about this ETF is that its expense ratio is just 0.03%, meaning that a $1,000 investment would result in just 30 cents of fees per year. Meanwhile, the SPDR S&P 500 ETF, or SPY, has an expense ratio of 0.09%, so 3 times as high as the expense ratio for this Vanguard fund. Like I mentioned, VOO is a reflection of the greater market as a whole. And at the moment, it's really hard to say where the market is going to go due to the increase in Omicron COVID cases. However, if you dollar cost average stocks like this, your wealth should accumulate quite significantly in the future. I think every investor should definitely have this stock in their portfolio, and it is why I have invested a significant portion of my portfolio into VOO. Okay, next up on our list is Intuitive Surgical, stock ticker ISRG. Intuitive Surgical is an American company that designs robotic tech to assist in surgeries and other clinical operations, with a primary aim of promoting minimally invasive procedures to ensure the safety of medical patients. Right now, its most notable innovation is its Da Vinci surgical system. Right now, one share of ISRG is trading at $363.94, with a 52-week low of $227.47 and a 52-week high of $369.69. Their one-year price chart shows exceptional growth in the last year, especially from March until September, and since then it's been hovering around $325 to $360 per share. They have a market cap of $130.013 billion, a P/E ratio of 78.47, and earnings per share of $4.64. They have a 5-year expected PEG ratio of 19.04, and they have a price-to-book ratio of 10.8, both of which show that this company is overvalued right now. The profit margin is at 30.78%, and they have a return on equity of 16.48%. And that's with revenues in the last 12 months of $5.49 billion. They're sitting on total cash of $4.13 billion, and they have a very high current ratio of 5.58. Analysts are rating them as a 2.2, meaning it is a buy, and the average analyst price target is $358.86, which is just under the current price of $363.94. While this company has been public since 2000, the last 5 years have been remarkable for Intuitive Surgical, as they experienced around a 400% growth, totally running laps around the S&P 500's growth rate. Now, a huge reason for this astronomical leap in the value for ISRG is that Intuitive Surgical has been consistently knocking its earnings reports out of the park, with incredible overachievements for the past year. What's even more bullish about the tech company is the fact that its Da Vinci surgical system has been in use by medical facilities and institutions since the early 2000s, representing significant longevity and proven competence with its inventions. Investors therefore have a reason to believe that Intuitive Surgical can continue to develop reliable machines in the future, and considering the strong emphasis on safety and reliability in the medical field, Intuitive Surgical has proven its trustworthiness. Meanwhile, their other remarkable invention is Ion, which is a robotic-assisted platform that basically scans lung tissue with minimal invasiveness. Ion recently received FDA clearance for the usage of its Sureform 30 curved tip stapler, which allows surgeons to approach the anatomy of a surgical patient through various angles. Getting FDA approval is huge for any medical company and once again shows the reliability of Intuitive Surgical's technology. In the short term, we could definitely see a dip for this company if certain surgeries are postponed as a result of new Omicron cases, but I do believe that they will grow in the long term. They'll be announcing their earnings on January 20th, so definitely be on the lookout for that. If you guys want to get hooked up with some free stocks, I will put links in the description below. I gotta say, investing right now for a short-term profit is very, very difficult. The overall market, especially tech, is on a serious downtrend, and most stocks could very well go down in the next few months. This is normal, and while they may go down in the short term, I really have high conviction in these companies long term. The long-term strategy of buying solid companies, holding them for many years, and borrowing against your portfolio to use that money tax-free is exactly what I am doing. I encourage you to do more research before buying any investments, as I am not a financial advisor and this should not be considered financial advice. It's just my analysis and the news and insights around 7 different companies that I currently like. If you want to invest, spend an hour or so researching each company for your own due diligence. And yeah, I just really encourage you guys to buy, hold, and forget about it. I'm not a fan of options trading on companies like these, so I encourage you not to do that. Anyways, those are my top 7 stocks for the month of January 2022. If you enjoyed the video, make sure to hit that like button and also subscribe to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thanks so much for your time. I'll see you in the next video. Peace.